Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep. Hello, investors. That's how we start the nightly videos. Let's kick off the podcast that way, too. You got me hosting. This week, it's going to be all charts all the time. And we're just going to jump right into it. Since we've got the new year, we're a week into the new year in the market. This is the 6th trading day. Year off to a pretty decent start after a choppy fourth quarter. And you can see that. I'll start drawing some lines here on the chart that I'm showing. This is the S&P 500. So from back in April, we had the tariff tantrum here. And anybody that follows us knows that our line in the sand is when we start hanging below this 200-day moving average, excuse me, this black line. And the fact of the matter is that's because all bear markets in history occur below this black line. You're above this black line. Really no reason to get overly concerned about the market. But obviously we prefer it above there, and we prefer it above all the moving averages that we track on our nightly videos. We've got a short-term trend, a medium-term trend, and a long-term trend that we follow on the indexes. And then when the wind is at our back, we dive into leading stocks. So market pulled back 20% in April intraday. Our losses in-house on our flagship growth protection portfolio were less than 10%. So we hit our goal. We don't want to lose, have more than a 10% drawdown from the top. So we accomplished that goal. We got a signal to get back in. This is the pie chart buy and hold. People always say you've got to be right twice. You got to be right getting out, and you got to be right getting back in. And nobody can do that. Well, that's because they can't do it. But don't get in the way of the people that can. At Revere, we describe how we do it every night on video, plus a weekend update from Todd, and we do this weekly podcast. We're also putting out a bunch of shorts every day, which are a quick 3-minute summary of the video the night before. If you don't have time to watch the details of the 15 to 20-minute video, the 3-minute is very easily absorbed. So back in April, we got back above the 21-day moving average. We started to trend above it. This was a very nice and lucrative trend for our clients. And then we started getting choppy in the fourth quarter. Down, up, down, up, down, and breaking the 50-day moving average. In fact, at this point, we got stopped out of all of our individual positions, or we had them hedged, and we're down to just index holdings for the most part. And then we rallied back up. We added exposure, stopped back out again on some things, rallied into the week before end of year. Santa Claus didn't come this year. We pulled back coming into the end of the year, but that 5-day or that 7-day Santa Claus rally, quote unquote rally, that is one of the signals for the upcoming year, finished with a loss of 0.11%. So we didn't get that, but we are getting good strength at the beginning of the year, above all the moving averages, and better than that, leading stocks are acting very well. What's not acting so well, surprisingly, is it's lagging on a relative basis, and that's the NASDAQ 100, and that peaked back in October. No chart is complete without a relative strength line, so you can tell what you're looking at and how it's doing against the overall market. And you can see how the market peaked here, or sorry, the NASDAQ 100 peaked here back in October, and is having a hard time making any progress relative to the S&P 500. But that's great. Why? Because all the market is just rotating into other sectors and getting strength. You can see how the NASDAQ 100 had not broken out on that prior chart. This is the equal weight S&P 500, which lagged for months on a relative basis until when? until October, about the same time that the NASDAQ 100 started to lag. And this is just indicative of money coming out of these big tech stocks and going into other areas. They're so big and so liquid that even minor selling on those big names going into other, as long as it's not leaving the market, and it's not leaving the market, it's going into other sectors, it's going into financials, industrials, and healthcare. And you can see how RSP, this is the equal weight S&P 500 on a relative basis, has been acting great, doing far better than the NASDAQ 100, but even outperforming the S&P 500 on a market cap basis. And again, that's just because of the lagging nature in the current environment of the NASDAQ 100 names. Case in point, Apple here. Apple had a great run from August into the end of the year. Apple is not a cheap stock. It has a PE of 35. It has a growth rate of 10 to 11%. That's a 3.5 PEG ratio. That's the PE divided by the growth rate. That makes it on the expensive side for a large stock like this. And it's very obvious that money is coming out of Apple. Nothing different happened with Apple when the clock struck midnight on January 1st. Except for the action. This has now had 6 straight days of selling with volume. And look at the relative strength line. This peaked back at the beginning of December for Apple. We don't own Apple broadly in the portfolio. We own Apple for some clients that have transferred it in or have long-term holdings in it with big gains. We've trimmed a little bit there. We're looking at hedging if these levels don't hold right here. But the money is going not from Apple, but clearly into names like Google. And this is the strongest of the mega cap stocks right now, the Mag 7 certainly, breaking out of a very nice flat base. And this is a stock that was just, people were talking about the death of Google back here because there were reports coming out. This was just in April and May of last year. There were reports coming out that search was down on Google because people were getting the answers right at the top when they go into Google from Gemini solving their question instead of having to go searching on a bunch of different websites. But that fear has been surpassed by the good stuff that that Google is doing in the AI world. And case in point, you can just look at the chart right here. Now, if I'm going to apply the same scrutiny that I did to Apple, we'll do it for Google as well. Last year had a PEG ratio of 1. Going forward this year, the PEG ratio is worse than Apple's was. But this is a secondary indicator. All of these A's for group strength, SMR, accumulation distribution, and composite, you can't pass that up when you've got a big stock, and we own this across the portfolios in-house here. Let's take a look at another one, Tesla. Tesla ended the year very strong, but since the beginning of the year, this has been showing relative weakness. So avoid it, right? Not necessarily. Let's go to a weekly chart really quick. In one of our segments this week, Alex, our option specialist, and is going to talk about why this is a great low-risk entry for options on Tesla. And you can see it just by the way it holds this longer-term 20-week moving average slash 100-day, basically the same moving average. So you don't always have to buy breakouts or the top names in the market. If you've got a theme that you have confidence in and it's showing a great low-risk entry point, there's no reason not to take the trade as long as you've got your stops in place. So let's pivot now. Actually, I'm going to save this for Connor because of his segment. He's going to talk about how small caps and mid caps are doing to start this new year. So very quickly, let's go back to the S&P 500. Let's look at a 60-minute chart. We spent a lot of time on this toward the end of last year. We focused on this tight range, saying from tightness comes expansion. We broke down out of that range. Then we had a reclaim and a breakout to the upside. Then we came back into the range. Then we broke out again. But this most recent pullback has held that range, the 6,900 level. And looky here, we're right at all-time highs on the S&P 500. We're recording this at noon on Friday. This morning we had a jobs report that came out that showed some mixed results. 50,000 jobs added versus 73,000 expected, but a drop in the unemployment rate. 4.5 was expected. It's 4.4. Market reacting positively. There was also some concern that the Supreme Court was going to have a ruling on Trump tariffs today at 10 o'clock. They came out and said they weren't going to rule on that today. And the market is reacting to the upside. And we talk about it all the time. Put your opinion aside. Go with what the market is telling you to do. Don't argue with it. And if you have questions, just follow us on social media or on our nightly videos. We keep you completely up to date with every change that we make to the portfolios, why we're changing it, and our outlook on the markets across 3 time frames on the indexes and across leading stocks. And we're very happy to see this money flowing into leading names to kick off the year. Both of our portfolios are outperforming nicely to kick off the year, especially TurboTax. They've got some really nice positions with some decent size to them, and we're really taking advantage of it. And clients be on the lookout for the year-end client update video, which will be coming out this weekend or early next week. But the bottom line is, if you're looking for a reason to be concerned, just take a deep breath and look at what the market is telling you. And since the market kicked off, doesn't mean it hasn't been easy. There's been a lot of volatility in some individual names as the institutions jockey for position with what they want to do going into the new year. There's also been some tax selling. We think Apple is a prime example of that, based on the chart that I just showed. But for now, everything's fine. What would change that for us? We're always looking at that. The first change in character would be a break of this 21-day moving average on the S&P 500. And it's just not happening. We tested it back on late in December and early in January. It held, pulled back a little bit yesterday. It held, and making new highs is not bearish. So if you follow our rules and you listen to us, you're taking advantage of this. If you don't have a approach to the market that allows you to participate in uptrends and get out of the way during downtrends, give us a call and we'd be glad to talk to you about why we think we're the best registered investment advisor in the country. And with that, I am going to kick it off to our team. We're going to start off with Alex and Tesla, which has been a little bit of a laggard, but in options world, that means when things are pulling back, that means that you're going to see some compressions on the premiums, and it can set up for a decent trade, great low risk trade. And what I'm showing here is a screenshot of Tesla. And Alex, you want to take over? Glad to have you back here as a special guest. You want to take over and talk about Tesla options?
Sure, happy to be here. So what you're looking at is a June Tesla 450 call contract and the price that it's been trading. So Tesla recently pulled back about 10 to 12% from the highs when we thought it was going to break out into new highs. Unfortunately, it came into the new year. We've noticed in the team, we were brainstorming yesterday and we saw that it was holding a big channel line that Don had just mentioned. So with a 10 to 12% pullback in a stock, this option has decreased by 50%. Okay. So the premium got crushed. It's all decayed. And the market makers are probably taking their eye off of it. So when I say that, I mean, if we were going to be buying at the highs, they're probably jacking up the ask on these options. So the ask price would be a little bit higher than it should relative to the intrinsic value, the underlying. So yesterday, Revere got alerted and they took some of these June calls, which today it's actually following up. So it might have been a good entry point with low risk because we have an area we know we can set the stop. For us, it's usually a 10 to 15% on the contract on a smaller size. We don't take 8% size options. It's 1 to 2. And so if the stock doesn't work, we can get at the appropriate price. But if this starts to trend back up, Tesla doesn't need to go up 200 points for me to get 100% gain. If Tesla goes back to, let's say, 500, a little bit higher, these options will go up 30 to 60%. I'll take that trade any day. So it's a 3-to-1 risk ratio, potential 10% loss or 30 to 50% gain. That's how you stack the deck in the options world. And also, instead of buying the Captain Obvious breakout, when the options are already up, this system, I'm gonna be testing more. And this is obviously the first one of the year. Might be a better strategy going into the future for options trading. It's a little bit, different than stock trading because you're playing the game of Greeks. If you don't know what Greeks are, you can look them up. But there's theta decay with time, delta on how much the option is going to move. But we took 6 months out, gives us enough time to sit if there's a little bit of chop, but also doesn't have that decay like most options do within a month.
Great overview, Alex. And anybody, if you don't know a whole lot about options, the key takeaway from what he mentioned is it is rarely the optimal play to buy options after a stock has rallied in a short period of time. The premiums are high. You're basically overpaying, as Alex just mentioned. It's a much lower risk, much better risk reward to buy a pullback to a key area on a daily or weekly chart where you would expect support to hold and buyers to come in. Not only from if you're just buying the common stock standpoint, but certainly with options, that's the case. Thanks very much, Alex. Let's go over to Ted now. Ted, or am I going to Ted or Connor? Who's next?
Me.
Connor. Okay. Connor is going to talk about some of this rotation that's going on in sectors, and we're going to start off with a screenshot of. Connor, explain what we're looking at right here.
Yep. Thanks, Don. Yeah. So to start, I have a picture, and if you've been following the market, probably noticed that there's been a definite shift into what's outperforming and what's lagging. And at Revere, we always want to be in the leading sectors and the leading stocks. And I came across this chart, and I think it displays a very good picture. So what this chart is a relative performance ratio of cyclicals versus defensive. And what you can see here is it's making new highs up on the right side. And basically what this means is, economic sensitive sectors are beating classic safety sectors, and this is very bullish. This means the market is favoring growth and risk. So industrials, financials, consumer discretionary, small caps, transports, and other pro-cyclical beta areas of the market are leading. And that is like a prime characteristic of a strong bull market. And on the flip side, we're seeing like worse performance in, consumer staples and just low beta safety things. And that again is typical of what you see in a strong market. And again, when looking back at this chart, we've seen similar moves in May of 2023. So back in that time, that's when cyclical started really breaking out versus defensive. We saw this in September of 2024 as well. Again, a great period in the market. And again, now we're seeing it clear as day. And this typically tends to be a stretch where we can really get out performance, and that's when you want to press it. And so this ratio chart just does a great job of showing that and what we're seeing. And again, this is a price chart. It's breaking out. So, long story short, you want to be long those areas of the market versus defensive. And if we look at some of the, Don, go to the next chart now. And then the other chart that I'm going to show is IWM. IWM is outperforming. This is a ratio chart of small caps versus the Qs. And again, no matter what, this shows the facts, and this shows that, since kind of end of December 30th, that's really when this ratio bottomed out. And you can see the big outperformance in IWM in the past couple of days and to kick off the new year. And so really good sign to start the year. And then now we'll look into some other ETFs that display this as well. And the first one I'm going to have Don pull up is KRE. And this is regional banks. And this is trying to break out of a huge multi-year base. And this is very bullish. If you go to the weekly as well, real quick, Don. And you can see essentially, right, you have some big, 20, 30, 40% rips inside the base, but we haven't really ever gotten that clear breakout into new highs and trending. And this looks like it's on the verge of setting this up. DPST is a great 3 times ETF to play this. And again, we like the ETFs here because, trying to find the best performer out of, a bunch of regional banks is much harder, and typically the 3 times ETF is going to outperform. And another one is ITB. This is home builders. And this is another one, big change in character day yesterday, and you can see the follow through today. There was some news yesterday overnight about, mortgage-backed securities, and that kind of is a potential catalyst. And again, you could see the setup, power of 4 setup, 821.50 and 200-day all really coiled up. And, in the type of environment that we are in right now, these can outperform quite. And just like KRE, this also has a 3 times ETF, which is now, and we've ran the performance graphs. Typically now outperforms individual names because, again, it has a basket, it has the torque being a 3 times ETF, and then you don't know what's going to be the best performing home builder. But, there is a basket like Toll Brothers, KBH Homes, etc., names like that. And then lastly, IYT. This is transports. And again, a great health of the economy. If transports are going up, probably means the market's bullish. And that's exactly what we're seeing here right now. They're breaking out of a very nice base, relative strength, confirming. And then, I'll finish off with XLF as well, just the broad financials. And again, this has been a Wall Street saying for a while. There's no bull market without financials. And, this is breaking out of a really nice base, great action in so many of the names. So all the action in these ETFs, looking at the ratio chart of cyclicals versus defense, outperformance in IWM, RSP, MDY, all this points to a strong market, and potentially see these outperform Big Tech or Mag 7. So I thought this was a good time to kind of walk through this, look at the different sectors and the opportunities that are shaping up in the market right now.
Great. So not only cyclicals versus defense, but the rotation from these big mega cap techs into small and mid cap names, very clear relative strength, as Connor demonstrated with that ratio chart, and also plain and simple on the chart right here. With IWM, you see it bounce nicely off the 50-day moving average and is making new highs. Great stuff, Connor. And let's segue from, if the economy's healthy, retail should be doing pretty well. Ted, don't you think? Got some names for us?
Yes, sir, Don. So the first name is owned in TurboTection, and that is VSCO. And so typically, like Connor said, we're kind of potentially entering the cyclical boom in the economy. And these are typically cyclical stocks, which means they tend to ebb and flow with the business cycle, with the economic cycle, and people's level of consumer spending that expands and contracts based off, interest rates, money supply, and just people's sentiment. And so we saw consumer sentiment rise today above expected. Building permits were higher than expected. So those are all some leading indicators of the economy, along with obviously the ultimate leading indicator, which is the stock market, which is acting well right now. So VSCO, really just a simple setup here. We had a gap up on the earnings, surprise, and that ran and trended against the 8 EMA for a little bit. And this just formed a perfect flag off the 8 and 21 EMA. So when it triggered that flag, that is when we took a position in Victoria's Secret. And what added onto this conviction is seeing how strong its group was doing. For example, if you pull up ANF, Abercrombie and Fitch, and AEO as well, you can see all three of these stocks just had really linear and big moves off their recent earnings reports. And that just tells us that institutions want these stocks. And then when you look at the stage analysis as well, they're back into stage 2 uptrends after a long stage 4 downtrend. And that's typically a good sign that these stocks potentially, and this group is potentially entering a new uptrend. So it's a short segment today. I'm still stocking AEO and ANF, and they're both seeing a little bit of volatility off this, this tariff news, but they're still acting well. Still watching to see if the 21 EMA can catch up, if it can retighten up again, and we might look to establish, a quote unquote retail consumer basket in the turbo protection portfolio.
Sounds like American Eagle made a pretty good decision getting Sydney Sweeney as a spokesmodel last year. So hat tip to them. Thanks, Ted.
Yeah.
That wraps up our 3 segments. Let's go back to the S&P 500, and we're near highs of the day and near all-time highs. And don't fight the trend, folks. If the trend changes, we'll talk about it on our videos. Not only will we talk about it, we'll take action. There's 3 things that are certain in life: death, taxes, and that an advisor that has no downside protection will your portfolio will take a beating during a bear market. They'll tell you to think long term. You're not an oak tree. You can only think long term for a certain period of time until you get close to retirement, and you start having to spend that money instead of worried about it growing. And that's what we hang our hat on at Revere. So we had a fantastic 2025 in AUM growth. And once the more people hear about our common sense approach, great for us and also great for them, because they can sleep at night not worrying about big hits to their portfolio. It's that simple. Dan's not here, but Spirit of Dan is, so I'm going to throw it back over to him to wrap up this week's video. Take it away, Spirit of Dan.
Well, thanks, Don. If you like what you heard, make sure everybody out there tells your friends, tells your family. Go over to revereasset.com, watch our content, like us on YouTube. Remember, it's your money, not their money. It's your money. We'll see you next week on Your Money.
Because, folks, it's not how much you make in the market, it's about how much you can keep.